Welcome back to In Business. Carlyle Group announced today that it raised $2.5 billion for its third fund aimed at deals in Asia. Carlyle isn't alone in seeing big opportunities in private equity in that region. Jack Wadsworth, Morgan Stanley Asia's honorary chairman, says that it's a good place to put your money to work right now. That's exactly what he's doing with his own venture, Yuan Ventures, a China-based investment firm which he chairs and he co-founded. He joins us now live from San Francisco. Jack, why is private equity the best place to put money to work if you're going to invest in Asia?
Well, I would say it's the best place to put money to work if you're going to invest in China. There are lots of ways to invest in other Asian markets that are open to international investors in terms of the marketable equities. That's not to say that private equity isn't a good way to put your money to work in those markets. But because China's currency is still a block currency, it's very difficult for global investors to participate in the equity markets. And as a consequence, the best way to play the market is through private equity. And there is now, I think, a backlog of experience, a track record with many funds that demonstrate good returns, both in growth equity and venture capital.
So you're saying there are barriers there to investing in China in other methods. This is possibly the path with the least amount of resistance?
That's right. There are well-established mechanisms for investing in domestic companies, and if you're successful, these mechanisms enable you to either sell the company or go public in the international markets, as opposed to just being restricted to the internal Chinese market. So successful companies can go public in Hong Kong or NASDAQ or even the New York Stock Exchange.
But
and,
isn't it also,
it's
investing in like a Chinese company in a sense. It's investing in growth via a Chinese firm. Therefore, it's almost like you're a local. I mean, isn't that kind of an acknowledgement that there truly are barriers when it comes to trade, when it comes to investment?
Well, I think you have to be careful. China is pretty open in the broadest sense to direct investment, to build a factory, for Intel to do a research center, for investment in real estate. There really is quite a long track record of China accepting, upwards of $100 billion a year this year in foreign direct investment. So it's the capital markets that are restricted, and this is very typical of a country that is watching the mechanisms carefully for its foreign exchange, its currency eventually trading. And China has studied the history of Indonesia, of Thailand, of Mexico, of Russia. It's very, very risky to open up your currency to full-fledged cross-border trading until you are ready.
And there's so much concern that they may actually be sort of carefully handling a bubble here and trying to manage a burst or prevent it from bursting. Jim Chanos on this network said we're on a treadmill to hell when it comes to looking at China right now. Why is he wrong?
Well, I think he is wrong. Bubbles are a function of inflated asset prices, and the stock market in China is relatively fairly valued. It's price-earnings ratio in the high 20s compared to the New York Stock Exchange, the low 20s. Real estate, I think, has risen in value, but there's still a lot of vacancies. And while there may be selective cases where markets decline, I would say we're very far from having a bubble. And if you look at the history of bubbles bursting, if you will, they burst because foreigners sell. I mean, that was the 1998 classic financial crisis, and foreigners cannot sell Chinese assets because they can't own them.
Yeah, well, we'll be interested to follow your investment in the region. Thank you so much for joining us, Jack Wadsworth.
Okay, Margaret, thank you.
Thanks for coming on.